Many new traders focus too much attention on technical indicators, such as the MACD and the RSI. While these indicators are useful, they fail to identify a point that defines risk. When to enter the market, set stops, and take profits can all be decided by using reference points like support and resistance. And pivot point is a tool that gives traders potential levels of support and resistance, and helps to reduce risk. In this video, we will build a powerful trading strategy by combining pivot points and traditional technical tools. The strategy that we are going to talk about today is perfect for those who are new to trading. Hopefully, you will be able to benefit from this strategy after watching this tutorial. Before we go any further, if you want to show us your support and help us produce a lot of new content, make sure you hit the subscribe button and the notification bell. It's only 2 clicks, but it means a lot to us. Again, nothing in this video should be taken as financial advice. This is purely for informational purposes. So without further ado, let's get started with today's video. What are pivot points? Pivot point is a technique used by traders to objectively determine potential support and resistance areas. Pivot points are calculated using the previous day's high, low, and close. In addition, other small calculations determine the outside points. You don't actually have to do the math because the trading platform will do it for you. I am using tradingu.com for our technical analysis. So first, let's add the pivot point to the chart. To add indicators, here we click the indicator menu at the top. And in the search menu, please write pivot point. And we're going to use this one here, pivot point standard. Click on it to add it to the chart. If you have followed the previous steps, your trading chart will look something like this. At TradingView, the pivot point tool shows you 11 levels, where the basic pivot level lies in the middle of the chart, and 5 of the resistance pivot levels lie above the basic pivot, and 5 support pivot levels lie below the basic pivot. This data is important because all pivot levels can act as intraday support or resistance. Let's make these pivot points more visible by changing their color. So click here on the indicator settings. And for P, I am going to change it to white. All support levels to red. And all resistance levels to green. Now, if the stock price rises through any of the pivot levels, it is a bullish indication and may indicate a good time to buy the stock. However, if the stock falls through any of the pivot levels, it is a bearish indication and suggests an opportunity to short the stock. But a trader should use the pivot point in conjunction with other technical indicators to maximize their odds of success. In this video, I am going to use the RSI with pivot points. So let's add the RSI indicator to our chart. So go to the indicator and search for RSI and add it to the chart. Now go to the indicator settings and in the Style tab, untick the RSI-based moving average. Also, I'll make the RSI white to make it more noticeable. After successfully placing both of these trading indicators on your trading chart, let's see how to use them. Let's start with the rules for entering long positions. For long positions, first, identify bullish divergence at the pivot point, either S1, S2, S3, S4, or S5, usually at S1. Second, when the price rallies back above the reference point, it could be the pivot point, initiate a long position, with a stop loss at the recent swing low. And finally, place a take profit order at the next level. If you bought at S3, your first target would be S2. Former support becomes resistance and vice versa. Let's look at some examples to help you understand. As may be seen here, a bullish divergence was formed here at the pivot point S1. And the price rallies back above the S1, indicating that the buyers are in control. We will open a long order at the open of the next candle. And our stop loss will be at the most recent swing low. And our first target will be at the next pivot level. Once the first target is hit, move the stop loss below it, and our second target will be the next pivot level. Let's look at another example. A bullish divergence was formed here at the pivot point P, and the price rallies back above the pivot point and closes above it. We will open a long order at the open of the next candle, and our stop loss will be at the most recent swing low, and our first target will be at the next pivot level R1. Now let's understand the conditions for entering a short trade. Entering a short position is the exact opposite of entering a long position. For short positions, first, identify bearish divergence at the pivot point. Second, when the price declines back below the pivot point, initiate a short position with a stop loss at the recent swing high. And finally, place a take profit order at the next level. Let's look at some examples. As may be seen here, a bearish divergence was formed here at the pivot point R3. And the price declines back below the R3, indicating that the sellers are in control. We will open a short order at the open of the next candle. And our stop loss will be at the most recent swing high. And our first target will be at the next pivot level R2. Once the first target is hit, move the stop loss above it. And our second target will be the next pivot level R1. Again, nothing in this video should be taken as financial advice. This is purely for informational purposes. So thank you guys for watching, and if you like the video then be sure to subscribe to our channel so that you don't miss on any of our new videos. I'll see you in the next video.